Hello and welcome to another episode of Economics 101 here at Rebel Economics. In this episode we will focus on risk and how it gets rewarded in a capitalist system. If you enjoyed these shorter videos and you haven't subscribed yet, go ahead and do it. We have so many more for you to check out. Done? Great. Then let's check out risk in economics. I have seen that it is helpful to think of capitalism as an equation that has multiple variables, which determine the economic output of a country, company, or individual. One of these variables is risks, and how it gets rewarded, and how it gets punished. Risk, as we all know, is the possibility of something bad happening given an action taken. In an economic system, this definition is not much different, but it is contextualized in the results generated from an investment opportunity. For example, when someone decides to buy a stock, they are willingly foregoing some of their very real cash for the possibility of future returns. That is what is considered risk. Such risk is a negative impact that needs to be offset by a positive impact in the form of the potential revenues to be received from an economic transaction. Generally speaking, in a capitalist system, the higher the risk, the higher the reward. But it is important to mention that this constant only operates in regulated environments. For example, it is true that investing in a startup is very risky, but once it IPOs and their stock is traded in the market, you might get rich. But it is also very risky to send Bitcoin to an address in a fake-looking email, and it does not mean that you will have a higher potential for returns. So, risk in a functioning capitalist system should be rewarded with potential gains that reflect the risk undertaken by the investor. Otherwise, innovation, company creation, and direct investment will suffer because the risks will be higher than the potential profits. For example, countries that have a high company tax undermine in some ways the profits received by owners of successful companies, thereby reducing the compensation for the risk taken by them when they put down their own capital to finance the early stages of that company. In contrast, countries that allow for legal frameworks that regulate the risk of entrepreneurs will see innovation bloom. Now, this is not to say that a legal system that encourages bad behaviors is good, it's not. But imagine, for example, if limited liability companies did not exist and every owner would be on the hook to pay with their own money to all of the creditors in case of the company going under. This will inevitably lead to fewer companies getting funded because the danger is just much higher. Just think of it this way. If I told you that we can roll a die and you will give me $10 for every non-6 result, but I will give you $100 for every time you roll a 6, what would you do? Admittedly, this is a risky game, but it might be worth it for you since the potential profits are larger than the risk taken. But imagine now if the state taxed your earnings 50%, meaning that you only get $50. Would you still play? Maybe you would, maybe you wouldn't. I guess it depends on your personality, but I am sure that fewer people would in aggregate. And the same happens with financial investments, company creation, and so on. Of course, wealth should be taxed, but this is just to say that sometimes it is not just about greedy rich people not wanting to pay taxes. Sometimes it is about risk getting rewarded and all the damaging effects that irresponsible taxation might have. So, thank you for watching this short video on risk. If you enjoyed it, give it a like and consider subscribing. I will see you in the next one, but for the meanwhile, here are some other videos of Economics 101.